Today, we're going to be talking about additional or extended replacement cost on homeowners policies. I hope you enjoy. We're talking about a homeowner's policy. Primarily, the thing people are focused on is what's usually considered coverage A, or the dwelling coverage. This is the part of the homeowner's policy that covers the actual structure, your home. Now, one of the most important things that you can determine is making sure you've got the home insured at whatever its current replacement value is, if it's a house that you can insure for replacement cost. There are some interesting coverages on a homeowner's policy, or interesting additions. Sometimes they're riders. It depends on the carrier. But they go by the name either extended or additional replacement cost. And what that simply means is, typically on your standard homeowner's policy, if it's determined that to replace that house would take $200,000, then you buy $200,000 of coverage to make sure that you've got it fully protected. What we get into is, with economics and things like that, especially when you look at where we're at right now in our current times, the cost of housing can significantly change, sometimes in short periods of time. And if you have the misfortune of having a claim at that point in time where the cost of building is much higher, or over time you've simply not adjusted your coverage, well, you can be left caught holding the bag. In other words, you got $200,000 of coverage on your home, you have a total loss, but it turns out you actually needed $230,000 by the time that loss occurred, so you're $30,000 short, so you end up having to come $30,000 out of your pocket. Well, the way this was addressed in the insurance industry was with this additional or extended replacement cost. So if you have that on your homeowner's policy, what it does is it gives you an additional buffer. So in other words, if you had $200,000 on your house, and that buffer will usually range somewhere between 10 and 50%. So let's get in the middle. Let's say you got a 25% extended coverage buffer. What that means is, if you have a total loss on your dwelling, technically you've actually got $250,000 of coverage if you needed it. So you got your $200,000 that you've insured it for, plus that 25% of extended coverage. So if you happen to be in that misfortune or that unfortunate situation where, when you had this total loss, the cost of building had spiked, you've got an additional buffer. Whereas if you don't have that, $200,000 is the maximum that your policy is going to pay, because that's the limit. Now, this shouldn't be confused with co-insurance requirements. You still have your co-insurance requirements where you have to insure to at least 80% of value. We've covered that in another Tuesday tidbits. We don't really have time to go into that today, but just know this is a way that you can protect, for a lot of people, one of their largest investments, which is their home. You can protect that value. So if you have that unfortunate situation where you have a total loss, you don't get left caught holding the bag. If you have questions about this or anything else related to home, auto insurance, or any kind of risk management, don't hesitate to give Terry or myself a call here at Westside Advisors with Insurance Services. I hope you have a great week.